thousands of company stocks are crashing abnormally. But for you, this is a once-in-a-lifetime buying opportunity. Welcome to my channel. Today, we're diving deep into three powerhouse companies: Netflix, Microsoft, Mastercard. Investing in them right now is investing in your future. On top of that, we're breaking down Trump's bombshell announcement, credit card interest rates to be capped at 10%. This sent shockwaves through the market. Lots of companies made reckless mistakes. Fake news surrounding this story has been spreading like wildfire online. Today, I am setting the record straight with this video. Let's jump right in. You've definitely noticed your stock portfolio balance shrinking lately. I am no exception. This isn't a problem with one single company. It is a mass sell-off across the board. All the big tech giants, NASDAQ leaders, even software firms haven't been spared. Adobe just hit a 52-week all-time low. In today's market, the so-called winners are all losers. Check your portfolio right now. It is basically a bloodbath. The goal of this video is to help you avoid pitfalls and save money. We've analyzed company fundamentals in depth to pick the three best stocks to buy right now. Number one, Netflix. Netflix's stock price recently plunged from a recent high of $133 to just $88. This price immediately caught my attention. I dug into Netflix's moves and found out they're planning a huge acquisition, buying Warner Bros. Discovery. Acquisition news usually causes wild stock swings. Netflix is no different, but after researching, I am certain. This deal is a masterstroke for Netflix. First, Warner Bros. Discovery owns a treasure trove of hit shows. Its IP value is off the charts. In the content industry, premium intellectual property is priceless. You've probably noticed most of Netflix's top content is licensed from other studios, especially Warner Bros. Titles. Warner also dominates the box office, and its streaming business is booming. But Warner has a fatal flaw. After spinning off from Amblin, it took on a mountain of debt since Q4 2022. The company has been suffocating under this burden. Every bit of energy goes to debt repayment. No money left for new content, talent, or tech upgrades. This is the key point I want to emphasize. Warner's content business is top tier. Anyone who knows its library knows that. But its financial structure is a disaster. Debt has trapped it in survival mode with zero growth. Netflix is making this acquisition at the perfect time. On one hand, Netflix gains access to a massive library of premium IP's A-game, changing boost to its content catalog. The other hand, it fixes Warner's broken finances. Netflix has deep pockets. It can easily afford the acquisition cost and take on the debt. This deal won't drag Netflix down and won't hurt its future investment plans. This is a win-win deal. Netflix saves Warner from collapse and grabs its valuable IPs in return. To make matters more interesting, Paramount has launched a bidding war. They don't want Netflix to get Warner easily. That is why I predict Netflix will switch to an all-cash offer. Why paying with stock requires endless financial reports and complicated accounting processes. It is time-consuming and costly. An all-cash deal cuts the timeline by months. Netflix knows Paramount is competing and will do whatever it takes to close the deal fast. The market doesn't seem to like this acquisition right now. Many investors are selling their shares. But in my opinion, investors and Wall Street are dead wrong. Netflix's stock price shouldn't be falling. And here is why. Stocks fall when a company's fundamentals weaken. Take Adobe, for example. Its valuation multiples keep shrinking because competition is fierce and fundamentals are getting worse. It is fighting off strong rivals like Figma and Canva, losing market share fast. It is nothing like it was a year ago. But Netflix is different. Its stock price is falling, but fundamentals are getting stronger. After acquiring Warner, Netflix locks in the win. This is an advantage no other company can match. There is simply no substitute. It will have an unprecedentedly large content library. Its content reserves and production capabilities will be industry-leading, something no competitor can touch. So here's the situation. A company with strengthening fundamentals, but a stock price that is falling irrationally. I believe right now is the perfect time to buy Netflix. But a word of warning. Netflix is a highly volatile stock. It could drop even lower, maybe to $70 per S-hair. But if the acquisition succeeds, its upside potential over the next 5 to 10 years is massive. If they manage the debt well and leverage the content, Netflix will deliver incredible results in the next 10 to 20 years. I predict its stock price will be several times higher than today. Number 2, Microsoft. This is my long-term favorite stock, not just for its stable software subscription revenue and strong cloud growth, but also for its rising share of high-margin businesses. Today, I am highlighting 2 key reasons. These are the most solid reasons to buy Microsoft right now. Reason 1, Azure Cloud Services, a growth engine firing on all cylinders. In my Microsoft investment thesis, Azure is always the number 1 growth driver. Even though Microsoft is already a giant company, Azure is still growing at an explosive rate. The latest earnings report shows Azure and related cloud revenue grew 35% YoY. Annual cloud revenue exceeded $75 billion for the first time ever. This growth rate far outpaces traditional software businesses, and Azure isn't growing by slashing prices. It is growing on the back of Microsoft's decades of enterprise customer relationships, its robust service ecosystem, and deeply integrated AI capabilities. This makes Azure's revenue higher quality and more sustainable. Reason 2, AI-powered productivity revolution, an underrated megatrend. If Azure is Microsoft's surefire growth engine, then AI, especially Microsoft Copilot and Azure AI services, is its most underrated growth driver. Microsoft's business is embedded in the daily work of billions worldwide. Microsoft 365 is used by hundreds of millions every day. And AI brings a revolutionary change. Companies can produce more output without hiring more employees. For Microsoft, this is zero marginal cost revenue growth. It creates an extremely powerful operating leverage effect, pushing Microsoft's already high profit margins even higher. The latest quarterly earnings are impressive. Total revenue $76.4 billion, plus 18% profit $27.2 billion, plus 24%. Diluted EPS $3.65, plus 22%. These numbers prove Microsoft is not just big and stable, it is growing faster than ever. From a long-term value perspective, Microsoft's intrinsic value is far higher than its current price. Its stock has had ups and downs over the past year, but the overall trend is upward. Recently, it is trading between $460, $480 per share. But in my opinion, its true value is at least $600 per share. I am confident that over the next year and beyond, Microsoft will keep growing and hitting new all-time highs. It is never too late to buy Microsoft. Number 3, Mastercard. When I talk about Mastercard, I always compare it to Visa. Both stocks have been under pressure lately, all because of Trump's social media post, proposing a 10% cap on credit card interest rates. This news sent both stocks reeling. But here is the big misunderstanding I need to clear up. Mastercard does not make money from interest. The interest you pay on overdue credit card bills doesn't go to Mastercard at all. It only earns a small fee every time you swipe your card. Mastercard is essentially a technology company, not a lender. It is a network platform focused on fast transaction processing, connecting consumers, merchants, and banks, ensuring smooth transactions, providing fraud protection, and verifying identities. This is its core business. After Trump's announcement, the market went crazy. Everyone was giving their hot takes. There are some supporters in the Senate, but the number is actually very limited. This is why I think now is the time to buy Mastercard. The market's panic over the 10% rate cap is completely unfounded. The chances of this proposal becoming law are extremely slim. Think about it. If the cap passes, credit card interest rates can't exceed 10%. Banks would basically stop lending to everyone, especially people with credit scores below 700. Your credit card would likely be canceled, and you'd never get approved for a new limit. Do you really think senators and representatives want to be blamed for taking away people's credit cards? Worse yet, the proposal would gut credit card rewards, especially for high-score customers who pay on time. Points, cashback, and perks would be almost eliminated. This proposal is a double whammy, hurting both high and low credit score users. Politicians don't want to be known as the ones who killed credit card rewards. House Speaker Mike Johnson already recognized this problem. He stated clearly, "While we are pushing to lower costs, we must proceed with extreme caution to avoid negative ripple effects. Banks may stop lending or drastically limit credit access." His words are careful, but he hits the nail on the head. This proposal isn't just bad for consumers, it is bad for the entire economy. Digital economy growth, stock market performance, and corporate profits all depend on convenient, unrestricted payment methods. Restricting credit cards would crash transaction efficiency. Overall, the chances of this proposal passing are close to zero. In my opinion, when stocks fall due to political drama, it is the best time to buy Mastercard and Visa are, becoming increasingly important globally, both structurally and strategically. I believe Mastercard will expand beyond traditional payments into new growth areas. Now this stock's valuation multiple, this at its lowest point in 5 years. I think now is the perfect time to buy. All right, that is all for today's video. The above content is only a personal analysis and sharing. If you enjoyed this analysis, please subscribe to my channel. We'll see you next time.